So most people have been told that if you're gonna be using credit cards, then you have to pay them off on the payment due date. However, in this video, I want to explain why that basic advice might actually be a bit misleading or even wrong in some cases, and why blindly following it could be causing your credit score to drop lower than it should be. That's because the real truth is there's a better day to pay your credit card bill if you want to give your credit score a little extra boost while also avoiding interest at the same time. So in this video, I want to show you how that works by walking through one of my own credit card statements to explain how I pay my bills as someone with a score in the 800s. And while I'm doing that, I'm also going to answer all the common questions that most people have about this stuff, but are sometimes a little bit too embarrassed to ask, like, should I leave a small balance on my cards? What's the difference between my current balance and my statement balance? And what's the best credit utilization to have? Now, before we get into all that, we got to start things off here by first talking about why I'm saying that paying off your credit cards on the payment due date isn't always the best thing to do. And the main reason for that comes down to how your credit score is calculated. Specifically, it actually comes down to the two biggest factors of your score that get impacted the most every time your credit card bill comes around each month. So those factors are going to be payment history, which accounts for around 35% of your credit score, and then amounts owed, which accounts for around 30%. Now, payment history basically just measures your track record with paying your credit card bill on time by at least the payment due date at the latest, where the goal is to have a 100% on-time payment history. And the way this works is that for every credit card bill or credit card statement that you receive, that is going to be for a certain date range called your billing cycle. You can see here on one of my own credit card statements that my billing cycle on this card began with my statement opening date of December 28th, and then ended with my statement closing date of January 27th. And during that date range, what my credit card issuer is going to do is they're just going to track any purchases or other transactions that I make on that card. Then, based on the sum of all those transactions in that billing cycle date range, I'm going to end up with a statement balance, which is also called my new balance here, and that is $63.65 in this example. Now, that statement balance is not going to be set in stone until we reach that statement closing date of January 27th, which is going to be good to know for when we talk about the amounts owed factor in just a minute. But when that closing date is reached and my statement balance is set, I'm going to have around 3 to 4 weeks until I reach my payment due date of February 24th, which is also listed at the top of the bill here. That 3 to 4 week period between my statement closing date and the payment due date is also called the grace period. And what I have to do if I want to avoid paying any interest while also making sure that my payment gets counted as being on time for my credit score is I need to pay that full $63.65 statement balance during that grace period by the payment due date of February 24th. However, what the credit card company is going to do is they're going to tempt me here, and they're going to say, actually, you only have to pay us a minimum payment of $40 that we list at the top here as well. And if you pay us that $40 minimum amount, then we're going to count that as an on-time payment as well. And you can just go and carry the remaining $23.65 from your statement balance over to your next statement if you want. Now, that's going to be a trap because by paying only the minimum, you're going to then start getting charged interest on that remaining amount at rates that can be around 24% APR or higher. So the golden rule here, and the first takeaway that I have for this video, is that when it comes to payment history, as you pay off your credit cards, you need to make sure you always pay your statement balance on time and in full by the payment due date each month. And just to make that clear, since there's a lot of variables here, I want to go ahead and show a graphic because I know I'm a visual learner and I hope that can help with anyone else watching this. So in my example, we had a timeline where the billing cycle for this statement opened on December 28th, and then again, it closed on January 27th. During that time, my total net purchases added up to be $63.65, which I actually manipulated for a very important reason I'm going to talk about later as well. So on my statement closing date of January 27th, my statement balance was reported as $63.65, and then I had a grace period that ran from January 27th until my payment due date of February 24th, and as long as I paid that full statement balance during that grace period before the due date, that's going to be counted as on time, which is good for my credit score while also avoiding interest. Again, here I'm going to basically ignore the minimum payment option they give me on my credit card bill, which was $40, and I'm just going to go ahead and pay the full statement balance instead because that minimum payment amount is actually included within my statement balance, which some beginners with this stuff don't actually realize, so they just go ahead and pay the minimum anyway. Also, a couple of quick bonus tips here, but if you accidentally forget to pay your statement balance by that payment due date, then don't get too worried because that payment is not actually going to get reported as being late to the credit bureaus until it's 30 days past due or more. You obviously don't want to make this a habit of missing those payments, but as long as you realize your mistake and then you go and pay what you owe before 30 days past that due date, then you're not going to see any negative effect to your score, but you still might get hit with a late fee, which could be up to around $40. However, if you simply call up your credit card issuer and then apologize and tell them this was just a one-time mistake, you can usually get them to actually refund you that late fee as well, which I've tried myself before and it has worked for me in the past. And if they don't refund you for that late fee, even after you explain yourself, then you probably want to just go ahead and take your business elsewhere and find a better credit card to use. So that's going to bring me to a quick reminder here that if you are looking for a new credit card and you want to check out any of the best offers going on right now, then we're going to have links down below in the description for you right underneath the subscribe button. Using those links is the best way to help support the free content here on my my channel, as well as just sharing this video with anyone else out there who you think needs to see this. So as always, thank you to everyone who shares my content and uses those links. Now, so far, hopefully all this stuff has made sense, because that's basically how paying your credit card bill works when your main concerns are simply just paying on time and avoiding interest. However, what we haven't talked about yet is how that other big factor of amounts owed affects your score as you're paying off your cards. And it's really going to be this factor that trips people up the most and drops their score without them even realizing it. So with amounts owed, the main component of this factor that we want to be familiar with here is called credit utilization. And what credit utilization does is it shows lenders how much of your credit limit you're using as a percentage of that limit. Lenders put a lot of weight on your utilization percentages, because if someone's using up too much of the limit that's been given to them, that can be seen as risky behavior, where a person is more likely to have trouble paying that back compared to somebody else out there with a lower utilization. Now, credit utilization is calculated by taking your statement balance on a certain credit card and then dividing it by the limit you have on that card. And it's actually looked at on a per card basis as well as on a combined basis across all your credit cards together. Most advice that you're going to read about online suggests keeping credit utilization below 30%, but ideally below 10% to have the best effect on your credit score. However, what I've found is that if you're really looking to boost your credit score up to its fullest potential with all else equal, then you actually want to be aiming for a utilization in the low single digit percentages like 1, 2, or 3%. Anything above 10% may be keeping your score artificially just a bit lower than it would be otherwise at a lower utilization percentage. And then anything that's above 30, 40, or 50% would definitely cause even a more significant drop to that score. But the good news is that credit utilization can be easily manipulated if you understand how your billing cycle works, with an additional step on top of what we talked about earlier. So back to my own credit card statement example. Like I said, my billing cycle was December 28th to January 27th, with January 27th being my statement closing date. And on that closing date, my statement balance was $63.65. However, without any context of what my credit limit is on that card, having a statement balance of $63.65 could be good or bad. But in this case, it actually is a good balance for me, because my limit is $8,900, which they tell me here on my credit card bill as well. So that means my credit utilization worked out to be just below 1% here, which shows the credit bureaus that I'm at least using some of my limit, but not too much. But what if I told you that my statement balance was actually supposed to be much higher here, and my credit utilization was supposed to be over 14% in this billing cycle, which would have decreased my credit score? And so in order to get it down to a 1% utilization, I purposely made a large extra payment way before my payment due date of February 24th. So if we scroll down to my transactions on this credit card statement, you're going to see that I had a few purchases that totaled $1,313.65. And that amount is also shown here next to purchases at the top, where if we took that amount and then divided it by the $8,900 limit, that would give me a credit utilization of 14.76%. So what that looks like on the timeline here is that from the billing cycle that was December 28th to January 27th, I made $1,313 in purchases, but since I didn't want to have a 14% utilization get reported, what I did was I paid off the majority of that balance before the statement closing date by making a $1,250 payment on January 26th. Doing that is what left me with the $63.65 statement balance and utilization just under 1% when the statement closing date rolled around the next day on January 27th. And then, like I said before, I had several weeks to then pay off that remaining $63.65 statement balance interest-free by the final February 24th due date. Now, I could have just let that $1,313 balance and 14% utilization get reported on January 27th by not making an extra payment, and I could have then paid that much higher statement balance by the due date of February 24th. But even though that scenario would also avoid interest, it would most likely make my credit score drop a bit at the same time, and it would be all because of how amounts owed and credit utilization work. So my next big takeaway that I want anyone watching this video to remember is that the best day to pay your credit card bill isn't just one day on your payment due date, but it's actually sometimes 2 days, with the first one being a few days before your statement closing date if your balance is just a bit too high relative to your limit and you have to make a larger payment to get that down. And then the second one being anytime during that grace period before your due date where you got to pay off the remaining statement balance. Now, that leads me to several questions that I know so many people out there have about this stuff, but are sometimes a bit too embarrassed to ask. So the first one here is, what do I do if I accidentally get a high credit utilization reported? For this, the cool thing with credit utilization is that it doesn't really have a memory as far as current credit scoring models are concerned, meaning that if you've intentionally or unintentionally had a higher utilization reported on a card for one billing cycle, which caused your credit score to drop, that drop is only going to be temporary. So as long as you then make sure that with one of your next billing cycles that you actually manipulate that utilization to be in the lower single digit percentage percentages like we talked about, you're then going to see your credit score jump right back up the next month. This has happened to me countless times over the years, and it's really not a big deal at all, so don't panic. And honestly, I'd make the argument here that unless you're really trying to optimize your credit score to be as high as possible leading up to getting a mortgage, a loan, or even applying for some other credit cards, then I would say you don't actually need to be micromanaging your credit utilization as much as I showed you. Now, there are some newer scoring models that do look at sort of a trend of your utilization over time, so it's good to be aware that this could be something that lenders take a look at in the future. But right now, most lenders don't use these newer scoring models, and so credit utilization effectively doesn't have a memory that you have to worry about too much. But then that's going to lead me to my next question here. Should I leave a small balance on my cards? And I think there's a lot of confusion and mix-ups that are going on when people ask this question. I think some people misunderstand what leaving a small balance means, because to me it means just leaving a small statement balance on your statement closing date like we talked about throughout this video, since that's going to be what gives you a lower utilization to boost your credit score. But then you still obviously have to pay off that statement balance in full by the payment due date a few weeks later to avoid interest. But to others, leaving a small balance is kind of mistaken to where they say to themselves, I heard that I need to leave a small balance to increase my credit score, so what I'm going to do is I'm going to make the minimum payment by the payment due date and then carry over like 20 bucks or something, because that's only going to be a little bit of interest that I have to pay on that. But that is going to be completely wrong, because you do not ever have to pay any interest to boost your credit score. You just have to better understand the terms here and the relationship between things like your statement balance, your statement closing date, and your payment due date. And speaking of your statement balance, the next question that I see a lot is, what's the difference between my statement balance and my current balance? So your current balance is something that's not typically even going to be seen on your credit card bill, because it's more of like this real-time live view of your balance that you're going to see most of the time when you log into your credit card account. Whereas your statement balance, that's going to be more like a snapshot of what you owe during a period of time in a certain billing cycle. So going back to my own example on that billing cycle that went from 12/28 to 1/27, my statement balance was determined by my purchases made during those dates, which was $1,313.65 minus that one large $1,250 payment that I made in that cycle. So my statement balance was $63.65. Now, that statement balance doesn't have to be paid in full until the due date of February 24th, but let's say that after my billing cycle ended on January 27th and that statement balance was set in stone, maybe my wife and I went out to dinner in early February and I spent another $100 on that card. If I still had not paid off that $63.65 statement balance, then my current balance would be $63.65 plus another $100 from the dinner charge, which is $163.65. So yeah, your current balance is good to keep track of as well to get a live look at what you owe in total, but your statement balance is really what matters when you're trying to pay off your credit card bill. But then if the order of the timeline is supposed to be statement opening date, then statement closing date, then payment due date, why is my payment due date actually falling before my statement closing date? This is by far the one question that I see beginners ask the most, and it's actually just a simple mix-up of the timelines. So the answer is that your payment due date is not falling before your statement closing date. You're just looking at your payment due date from the previous billing cycle. So again, back to my timeline, the opening date is December 28th, closing date is January 27th, and payment due date is February 24th. But now if we start to lay out the next billing cycle on this timeline at the same time, the opening date on that next one is going to be January 28th, the closing date is going to be February 27th, and the payment due date is 3 to 4 weeks later on March 24th. So the confusion is that people see the due date on the first billing cycle overlapping and usually falling a few days before the statement closing date on the second billing cycle, but those dates actually fall under separate credit card statements, so your payment due date is always going to be after the statement closing date. Now, throughout this video, we focused on 2 of the 5 factors that can affect your credit score the most, but there's still going to be 3 other factors that you have to know about as well. So if you want to understand the full picture on how to increase your credit score dramatically with those 5 factors, then make sure to go ahead and check out this video over here on the screen next. But as always, thanks so much for watching.